This is the part of our series, Understanding Markets. Today we cover the importance of time as it relates to the domestic stock and bond markets. My name is Wes Shannon, and I'm a certified financial planner with SJK Financial Planning, a fee-only registered investment firm in the Dallas-Fort Worth metro area. This is an educational video, and it's not a recommendation for any particular investment. We'll be using two indexes, the S&P 500 index, including the monthly dividends, to represent the stock market, and the Barclays U.S. Aggregate Index for the domestic bond market. The principles we'll discuss apply to all stocks and bond markets, foreign and domestic. Remember, indexes are unmanaged and their results do not reflect any fees, commissions, sales charges, or management fees. This is a graph of what $10,000 invested in August of 1987 in the S&P 500 index would have grown to by August of 2016. I picked this date because August 1987 was when I started my financial services career. This graph is familiar to me because I've seen every day of this 29-year period in the markets. That $10,000 would have grown to $130,680 today. That's a total return of 1,200%, or an annual average return of 9.24%. This includes two record crashes in 2000 to 2005, and again in 2008 to 2011. This graph is for millennials who definitely have 29 plus years to accumulate wealth. And also for most Generation Xers and young baby boomers have 29 or more years too, since the medical industrial complex is working around the clock to keep us living longer. Let's look at what a short-term frame of only 1 year would have done. There are 29 one-year periods between 1987 and 2016. 24 of those made money and 5 showed a loss. The best return was a whopping 48.67%. After 1 year ending in 1997, the $10,000 would have been worth $14,863. But that was the best year. The median for those 29 years was 12.85%, but the worst was a loss of 25% back in August of 2002. Then the $10,000 was worth only $7,384. What made it even more worse was that it just followed a previous year in 2001 with a 14% loss. The point is, you only have about an 83% chance of success on a 1 year time horizon. A 5-year investment plan didn't have any better odds of being successful than a 1 year time frame. The worst period was a loss less than the 1 year loss, but after 5 years ending in 2004, the $10,000 would have been worth only $8,929. Not a great place to be in 5 years. So with a 5-year investment horizon in the stock market, there's still a 20% chance that you'll end up with a loss after 5 years. Now with a 10-year time frame, there's an improvement in the success ratio up to 90%. Only 2 out of the 20 10-year time periods were losers. But still, you had a 10% chance that your investment will be less than what it was when you started after 10 years. No one lost money on a 15-year or more investment period during the last 29 years. Even the worst return of 4.37% was better than what the banks and insurance companies offered, and the original $10,000 was worth $18,985, almost double, at the end of 15 years ending in 2012. All of the periods greater than 15 years show gains. For 20-year periods, the worst return was 7.72%. Understand that most of our lives we are saving for 15 or more years into the future. Even a retired person up to the age of 75 should plan on at least a 15 to 20-year investment horizon. Unfortunately, many people fail to match their investments with their investment horizons. Now let's take a look at the bond market. Here's the same $10,000 invested in the Barclays Aggregate Bond Index for the same 29 years, from 87 to 2016. By 2016, the $10,000 is worth $65,310. That's a total return of 553%, or an annual average return of 6.66%. You don't see the big crashes in the bond market as you did in the stocks. Bonds, for the most part, are a good counter to stocks. A whole lot less volatility, but at the price of less returns. Bonds have a higher success ratio for a one-year time frame. The worst year for the year ending in August of 2013, the original $10,000 would have been worth $9,810. For the past 29 years, an investment of 3 or more years in the bond market have always resulted in a gain. Even the worst returns in bonds exceeded the rate of returns offered by banks. The question remains, is the investment meeting the length of time for the goal? The bottom line is time will reduce the risk of loss. It is so very important that the investments match the goal. When they do, you don't have to be worried about market corrections or crashes. That's for the short-term speculator, not the investor. Seek the advice of a registered investment advisor or RIA to build an appropriate portfolio for your goals. By law, they must act on your best interest as a fiduciary. There are literally thousands of investment opportunities out there, but a caring professional will match you up to the ones that match your goals. Thank you for watching this presentation, and look for the next in our series of Understanding Markets. Also, check out our website at sjkfinancialplanning.com and follow us on Facebook, YouTube, LinkedIn, and Twitter.